Good morning, and thanks for joining us here on Treasure Coast Solutions every Wednesday from 9 to 10 o'clock. I talk about boring stuff, and you listen, or you don't. I don't know. Our listening audience is somewhere between a gazillion and two. But I know usually that Evan's listening because he has to make sure that he doesn't have to bleep me every now and then, and so I've got his attention. And other than that, I don't know. I used to say my mom listens, but she's passed away, so I'm kind of on my own here. But for those of you that are new to the show, as I always say, I apologize. Get it going good early, and let you know early that you're in for a treat. But seriously, we've been doing this show for a while, and the purpose of the show is really to have some fun, but also to talk about some of the economic issues that happen in the world and how they might impact you. And I know that's a boring subject most times, but the trouble is that it is something that's important. A lot of times when we hear somebody tell us something, we don't, we may not have the background because we haven't been exposed to it. It's not an intelligence thing. It's just a background that, we may not know whether they're telling us the truth or not. And a lot of times, politicians in particular, they have their own truth. And I know they really believe it. But then there's also, other sides of truth. Like, for example, this wall that divides this office here, I pretty much can't walk through that. I know that something in physics, I'm not a physics expert, but I'm pretty sure something in physics says that I can't walk through that wall. Now, as a politician, I can tell somebody, I'm going to allow you to walk through that wall, and you're going to be okay. And I may really believe that. I may believe that I have the power to have you walk through that wall, but it ain't going to happen. And that's kind of the way it is on economics. Many, many times we'll hear people say something, and it isn't going to happen. They would like it to happen. I would like it to happen sometimes, but it isn't going to happen because it's like going through the wall. You can't go through the wall because there are certain economic principles that just don't change. No matter how many times you do them differently, no matter how many times you try to do the same thing and get this certain outcome, you don't, because that's the science of economics. Some things there's an art, some things there's a science. And I think that when you have a science, like we hear on the radio all the time, you have to listen to the scientists. Can't understand why they don't listen to the economists. But then again, you have economists, i.e. scientists, that say different things because they want you to believe different things. They want you to try to walk through the wall, and it ain't happening. So anyway, that's kind of what we're talking about, some of the issues we're talking about. And my name is Mark Breckbill. I'm a CPA, an ex-banker, and have dealt in the world of finance for some period of time. I've worked for a large CPA firm, one of the international ones, and I've worked for large banks and was chief financial officer of a very large bank, about $500 million or so, a little more than that, and and at one point was chief operating officer of a community bank. So I have had an opportunity to deal with finance in particular and economics as it relates to finance. And notice I'm not saying necessarily accounting. Truthfully, accounting is a science to some degree, but there's a lot of flexibility in accounting principles. And so when you talk about when a entity or a person talks about principles and coming up with an opinion or an approach and whatever, usually they're talking about an art. And even in accounting, if I'm talking about how to record income, believe it or not, in accounting, there are multiple definitions of income and multiple definitions of how you record that. And it varies depending upon, on what I'm accomplishing. So it's like I was talking to my grandson, actually my granddaughter the other day, and she's 4, And so we were doing some addition. Of course, being a CPA, I got to start those kids early. And so we were working on some just basic addition. And, what's 1 + 1? And, uh, and she hesitated for a minute on that, and which was a good thing, by the way, because I know many of you out there are thinking the answer to that is two. And if you were talking about basic mathematics, you're right. But if you're talking about accounting, the correct answer for that is, what do you want it to be? So that's the difference between an art and a science. Mathematics, pretty basic. 1 + 1 is 2. Accounting, 1 + 1 may be what I want it to be. So it's the same thing with a lot of things out there, is that there are different definitions. And as I've said before, there's a different definition for income in economics than there is in accounting. Economic income is different than accounting income. And accountants get very frustrated with economists because of that, because they don't agree with it. But it is the science of economics, and that's the issue that you got to deal with, is that income is different, and it's different at different levels. With economics, you have what they call macroeconomics, which is basically the more of the economics of international or national, global type. It's a large scale, kind of a big picture approach. And then there's microeconomics, which is more the economics of business, of individual entities, and of individual transactions, that type of thing. And so, so part of understanding economics is knowing which part of the economic equation we're on. Are we talking about, gross national product and gross domestic product and all of those things that are macro in basis, or are we talking about revenues and costs at the business level? And for most of what we deal with in our lives as individuals, we're dealing with microeconomics. The macro kind of is out there, and there's calculations. Those calculations, due to a lot of different variables, are not always accurate, only because the theory is correct, the science is correct, but the numbers aren't always correct. We don't always have the full picture. We don't always have all of the numbers. And so that's why sometimes people get confused. They look at something and say, well, this is happening, and this is supposed to happen, and it didn't. Why? Well, it may have, or it may have been delayed slightly, but you don't see it because the numbers aren't there. You don't have the right calculation, because you don't have all of the facts, basically. So anyway, that's kind of the general thing we've been talking about. And one of the things that I've been trying to talk about a little bit, because it's becoming important in this political season. And again, this is not a political show, so I'm not really trying to talk about the art of politics. I'm trying to talk about the science of economics. But it's important because certainly economics is affected and sometimes infected by the political aspects. Politicians want certain things to happen. They know what are going to happen in the short run, and in general, because they're not fools, although we may think they are. They know what's going to happen in the long run. And many, many, many times, and this is true in business as well, the person involved only cares what's going to happen in the short run. They do not care what's going to happen in the long run. Why? Because they don't anticipate that they'll have to deal with it. I'm pretty certain that Joe Biden 47 years ago didn't think he'd have to deal with some of the decisions or lack of decisions that he made 47 years ago. I'm pretty certain that President Trump is confident that he is not going to have to deal with the long-term decisions that he is making right now. He's focused on an election, and he's focused on the issues that that the taxpayers and the voters are concerned about in that election, and that is, the economy and how soon and how fast it's going to come back. He, like many politicians, aren't always worried about the economic outcome that's beyond their term of office because they won't have to deal with it, even though they may know that that's what's going to happen. And I'm not picking on any one person here. I'm picking on them all because it's absolutely true. I truly believe that most politicians, maybe not all, definitely not all, but most politicians, especially in the Senate and in the administration, understand economics and what the cause and effect relationships are going to be. If they don't fully understand it because they're lawyers and not economists or whatever, they do have people that are advising them. They didn't get where they've gotten by not having either arrogant enough, which may be the issue, to believe that the person that's giving them the advice is wrong, or they may believe that the person that's giving them the advice has an agenda and is trying to, undermine what they're trying to accomplish, or they may just choose to ignore it because they figure it won't affect them in the short run. That's kind of where we're at. And so I want to talk just a couple things. We've been talking about some of these things, but some of the myths and legends that exist in the economic and political arena right now. For example, the fact that the economic stimulus package will only have a positive impact on the economy. In the short run, that's absolutely true. In the short run, it will have a definite positive impact on the economy. And by short run, I'm talking, 8 to 10 years or less. And see, that's the other issue. You gotta define terms when you talk to politicians. For example, politicians have been throwing around the term rich for years. We're only going to tax the rich. We're going to tax the 1%. We're going to tax the wealthy. We're only going to tax those people who can afford it. The middle class will not be taxed. We won't tax the working poor. Nobody will pay taxes that can't afford them. And those are some really good statements. They're all lies, but because they're not defined. They're also truths. Because, for example, if I define wealthy as anybody who makes $70,000 or more, then and I'm talking combined income, joint income, $70,000 or more, then pretty much, yeah, I'm not going to have to tax many people under that. I'm going to hit most of everybody at that point. A large portion of the population makes joint income of $70,000 or more. And so if they're going to pay tax, they're the ones that got to pay tax, because the fact of the matter is the government can't raise enough revenue to pay off this debt unless they tax the lower middle class. So now if I'm a politician and I'm going to tax the lower middle class, I have to get out my shell and the little p and start moving stuff around so you can't follow the p and find out what the answer is. So that's what I'm going to do. I'm going to start my shell game. And I'm gonna hide the tax. That's what we're gonna call it. We're gonna call it hide the tax. So how do I do that? Well, first of all, I don't call the tax a tax. I call it an investment, because nobody has a problem with an investment, right? So the first thing I do is try to rename it. That's how I hide it, and that's the big key. And that's what you got to watch when you're watching the shell game that we call politics. Is that you got to focus first on what are we looking for? So we're trying to hide the tax. We're trying to cover that up and make sure you don't find where I put it. So the first thing I'm going to do is call it something different. Call it an investment. I like investments. People like investments. That indicates that this is a long-term answer. No, it's just a long-term cost. You know, it's going to create some short-term benefit that's got a long-term cost because the government doesn't invest. They don't earn income. All they do is redistribute. People forget that. That is the one thing that people just have a hard time with. That tax is not income to the US government. A tax is a reallocation of wealth or income among the people. It's taking it from one group and giving it to another group. We're either allowing the market to determine which group we're taking it from and which group we're giving it to based on market conditions, or we're allowing the government to dictate that. The government can decide who they're going to take it from, how much they're taking, and who they're going to give it to based on their current feelings of what's fair, appropriate. Again, what kind of investments we need to make. We're making investments in infrastructure. We're making investments in roads. We're making investments in whatever. They like to talk about that. The thought is, well, if we make this investment, for example, let's say we go into a city and we demolish a bunch of buildings because they're old, and small, and not efficient. And I'm putting efficient in air quotes. So we demolish those and we decide to build bigger buildings that are going to provide better housing and more business opportunity and all of that kind of thing. The first thought is that, oh, that's a pretty good deal. See, I'm making an investment in the future. No, what you are doing is causing a cost in the future to maintain the city services and other things that have to be maintained for that investment. That's why, if you actually look at it from an economic standpoint, infill building makes way more sense than developing a new site. So instead of tearing down the mall, for example, and building a new place out there, or instead of tearing down a portion of downtown and then rebuilding it somewhere else downtown from scratch, it's going to cost more, because by the time that the city is able to, or any municipality, I'm just having to mention city, by the time you've realized the economic benefit of that infrastructure, it's time to replace it. And the ironic thing is that by the time you've recovered your investment, we're calling that an investment, by the time you recovered your investment, you now have to spend an equal or greater amount of money to reinvest and improve it. Well, it's not an investment if you never get a return. That's why it's a reallocation of tax dollars. It's taking it from some taxpayers as real estate taxes, putting it in another location as a benefit to businesses or whatever, but they're not going to pay for that, because yes, they are going to pay more taxes as it develops, as it economically gets, becomes more developed and more viable and generates income, and sales taxes and real estate taxes and property values go up and all those things. Great thing. But if you've had to put in a significant amount of infrastructure to do that, street lights, underground, utilities, water, drainage, whatever you're talking about, all these things that need to be done to create infrastructure, roads and parking and all of those kind of things, by the time you've made up for that with real estate dollars from that location, it's time to replace those things. And those are city services, so they're not going to be shifted to the taxpayer. Whereas if you allow people to build on the areas that are open within a city, the undeveloped or underdeveloped areas. You take spots and let people build. Even if it's a small place, you let them go in and build. There is no additional infrastructure cost, no underground, no lighting, no anything else other than and the property owner is paying for that. So the property owner is paying for the investment that needs to be made for their activity, and it has no additional cost. Whereas if a city is developing an area in a redevelopment project, unfortunately, all that infrastructure that's got to be put in there, it's going to be very hard to recover all of that in the time frame necessary. You look at Azul. Azul is a great project from the standpoint. That's the apartments here in Stuart that were built on the Triangle property. It's a nice project, good investment. But with the amount of work that had to be done on that site, infrastructure wise, in terms of some of the things that have to be done and still have to be done, it's going to be tough to realize all of that benefit. If the property owner on that hadn't been given a big discount, which is the cost to the city. So you say, well, what did the city have to do? The developer did it all. Well, the city gave them a free lease for 4 years, maybe 5 years. They're not fully up to the fair market value of that lease for that land that they built on. That land was worth about $1.5 million, maybe 1.8 at the time that it was leased to Azul. The effective lease cost put that land value at about $300,000 or less. So the city made a $1.2 to $1.5 million contribution to the infrastructure of that by the way they structured the land lease in that, because the city owned the land. So now when you look at the costs associated with that and the city services that have to be provided, is the city going to make back that $1.5 million in the short run? Well, probably takes 10, 12, 15 years. So by then, what is the city going to have to do? Are we going to have to make more improvements there because of the impact on the river? What are we going to have to do at that site? And who's going to make those changes? So that's kind of the issue that exists typically from city planners that I've had an opportunity to be involved with. In fact, the city provided a workshop a number of years back where they brought a guy in who talked about this very subject, and he was very clear on that and the costs of redevelopment versus infill building, and for a city and realization. So that's one of the things that kind of off a little bit, but it's important to understand what the definition is and what we call stuff. So a lot of times politicians try to call stuff investment when what they really mean is tax, or it may be a tax benefit, but it's a tax that they're calling something else. The first one and the most common among people that want to tax you is to say, we're going to take your money to make an investment. That assumes I'm going to get my money back. I usually, if I make an investment, I want my money back. Ask a politician if they're going to give you your money back. No, they're not. So that's not an investment. If you don't get back your principal, it's not an investment. It's an expense. So that is always the first question I want to ask somebody when they talk about we're going to make an investment in an infrastructure. I'm going to say, okay, am I going to get it back? And I'm not going to get it back in some esoteric, the world will be a greater place. No. Am I going to get my actual cash back? That's an investment. If I get my money back, it's an investment. If I don't get my money back, it's a redistribution of wealth. It's a redistribution of my income, which is what the government is very, very good at. The government doesn't make investments because they never give you your money back. They always redistribute income. So that's the first thing. Investment is not investment. It's redistribution of income. You're never going to get a government investment back. 2, inflation is tax. That's the most unfair tax. That's why politicians shy from it. They don't want to admit that they know it's a tax. But inflation is the worst kind of tax. Why? Because it impacts those who can least afford it the most. We have all of this stuff. People will stand up, politicians will stand up on a chair and talk about regressive taxes and, taxing the poor more than the wealthy, and that's not right. Warren Buffett will stand up and say, my secretary pays more in taxes than I do. By the way, that's a lie. That's an absolute lie. But people think, because why? Well, first of all, you also have to understand when a politician's lips move, they're probably lying. So when Warren Buffett, who is a quasi politician, says, I'm paying higher taxes than I'm paying lower taxes than my secretary. Well, first of all, Warren Buffett's secretary probably makes a whole lot of money. That's not somebody making $25,000, $30,000 a year. Trust me. That's somebody probably working for Buffett. I'll bet you she's making at least 185 to 200,000. So depending upon your definition of wealth, she may be in the top 1% and deserves to pay more money than Buffett. But let's say she's not. Let's say she only makes 150,000 a year. So she's poor, right? Because she's not, obviously, she's probably not in the top 1%. But what Buffett's talking about is there's no way on $150,000 that she's paying more in total tax dollars than Buffett pays on billions. A few $100,000, a few $1,000, $50,000, $100,000. If she was being taxed all of her income on a pure dollar for dollar basis, she makes 150. Let's say they were taking 150,000 away from her, which we know they don't, right? So let's say they took $150,000. How much is that on a billion? That's a rounding error. That's a Buffett rounding error. He's got numbers that he just didn't want to look up that he put down that are higher than that and paid tax on. So he probably, his meals and entertainment expense is probably higher than that. He didn't get to deduct. So the fact of the matter is, on a dollar for dollar basis, he paid way, 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 way more money in taxes than he or she did, whoever his executive secretary is. So that's the first fallacy, is that you gotta pay attention to what they actually mean, not what they're saying. That's the sleight of hand. See, we're moving it around. We changed the names. We're moving it around. We're playing loose with the discussion. So now we're talking about he pays more in taxes. What he means is that she pays a higher tax rate than he pays, or that's a higher tax rate. All right, higher tax rate. What's that mean? It means that the income that's being taxed to the executive assistant is being taxed at ordinary income tax rates, which, if you make enough money, which this person probably does, is probably close to 35 to 37%, right? Not including Social Security taxes and everything else, which, again, Buffett's probably including all that stuff. So by the time you take Social Security taxes, which, are another 7.65%, and you take income taxes, which are 35%, this person is paying an effective tax rate of up over 40% with taxes and everything else. Now, Buffett, because he deals in capital gains and long-term investments, he's paying long-term capital gains rates. Why? Because the government doesn't tax capital gains at the maximum rates. They tax it at 20% or 15%, depending upon the bracket you're in, maybe even 0, depending on the bracket you're in. So when he's saying I'm in a 20% bracket, she's in a 40, she or he is in a 40% bracket. I think his secretary was a woman, but anyway, is in 42%. So she's paying more than me. Baloney. 42% of 150,000 is still a lot less than 20% of $1 billion. So that's one thing. The other thing is, Buffett is going to pay the tax. He's just deferring it. So when he's saying I'm not paying it, that doesn't mean he's not paying it at all. All he has done is deferred some portion of it. And that he's done that by not selling something. And that's what we want. We want the investment, because individuals can make investments. We want that investment to stay. We want that money to stay in the economy so that the businesses that he invests in can get bigger and can produce more jobs and more economic output. So we want that to happen. We want him to do that. And so to encourage him to do that, we're telling him, if you leave that money in for at least a year, we're going to tax you at a lower rate. We're going to tax you at 20% instead of 35%. Right? So that's we're doing that. We're saying to that person, because we want to redistribute wealth. Now, what we're hoping is we're redistributing wealth through him to someone else. Probably not true. We've made him a very rich person. And so our investment that we allowed him to make on our behalf by allowing him not to have to spend tax dollars has allowed a redistribution of income in an overall basis from the working person and everybody else to Buffett. So, if Buffett feels so bad about that, all he has to do is write a check for more money than he owes. That's always been allowed. I've been doing taxes for 20 some years. I've never had a client say to me, I'd really like to make an extra payment to the government. I don't expect to get it back as a refund. It's not my estimated payment. I just want to I'm going to write the government another $5,000 just because they need it. I've never had anybody say that. You can do that, by the way. So if you're interested in doing that, give me a call. I'll help you figure out how to make that happen. Interestingly enough, it'll probably take a long time to do that because the government's going to keep trying to give it back to you, because they're going to keep saying to you, you don't owe this money. You don't owe this money. We don't want to take it from you unless we want to take it from you. And we don't think you owe it, so we're not going to take it from you because you don't owe it. But I want to give it. Sorry, you can't give it. It's yours. Take it back. But I can find a way. We will find a way for you to pay that extra money voluntarily. And if Buffett wants to give me a call, I'll help him find a way, to pay a couple extra $1 billion so that he can help out. Think about it. If he's such a patriot and he's so concerned about this issue, and he feels like maybe he makes more money than everybody else does, and that's not right, he feels that that's unfair, well, let's take some of his billions, voluntarily put it up. I'm good with any rich person that wants to voluntarily put their money up. Frankly, they made it. They have a right to keep it. And unless they made it by me giving it to them from the government, a redistribution of wealth from the poor to the wealthy, which is what it would be if it came from me and went to them, then fine. I don't agree with that. I want my money back. But, if they did something, they expanded the economy, created jobs, created wealth for other people, and they made money as a result of it, that's theirs. Now, if they want to voluntarily give it to other people, that's their prerogative. But I don't think it's the government's prerogative to take it away from them just because they've been successful. And frankly, if there's a chance the government's going to take it away from me as an investment, as inflation, then I'm going to find a way to avoid that. How am I going to do that? I'm going to move my money around to the extent I can to avoid those costs. And if I own a business, I'm going to find a way to either relocate it someplace where I don't have to pay taxes, i.e. offshore maybe, or I'm going to just decide not worth it. I'm out. I don't need to create those jobs anymore. It was a good run while I had it. I'm out of here. So don't be fooled by the idea that the wealthy will pay tax. The wealthy won't pay tax if they're passive wealth. The only wealth that will pay tax is non-passive wealth, business wealth, where an individual or a family or a group of individuals on a small basis own the business. I'm not talking about a publicly traded company. I'm not talking about any of that type of thing. I'm talking about the situation where somebody has a business that they've established, they've grown that business and tried to maintain it and grow it over a number of years, and now they have a value in that business that's significant. They can't tap it yet unless they sell it because it doesn't have that much in cash. So if my business is worth $3 million, I don't have $3 million in cash in my business. That would be foolish. And I wouldn't be able to do it. I couldn't do it. There's nothing I could do with that. But what I have in my business, if it's worth $3 million, what I have in my business in most cases is what's called goodwill. It's the name, reputation, and value. I mean, look at some of the businesses around town. Take a look at some of those. You know who they are. They've been around town for years. Do you know how much they have in assets, how much they have in cash, how much they have in debt? You don't know any of that. But you know they have value. Why? Because you recognize the name and you know the name is symbolic with quality in their industry, right? So so that's goodwill. That's wealth that's there, but it's not available to be spent. You can't spend, you can squander it. You can squander goodwill instantaneously. A company can destroy its goodwill and thus its value instantaneously. And a business owner lives with that every single day. They have this valuable asset that if they sell, they're going to get taxed on and probably lose most of it. But they face the risk that every single day something can happen that they may or may not control that results in them losing their business. Years and years ago, there was an electrical company, an electrician in town. A very, very good electrician, had a very, very good reputation. They were working on a project. They had a crew out. They were working on a project. I think it was over on Hutchinson Island. But anyway, Sailfish Point, maybe. They were working on a project, and some people got electrocuted. It was really bad. It was I think it was faulty work. But even if it wasn't, like I say, just the fact that it happened, it really kind of destroyed the reputation of that business. Even though it was just an accident that maybe or may not have been avoided. It was a problem. But there was a business that had significant value, and because of one event, it instantaneously went away. And they had to rebuild that. I don't know if they did, but they had to rebuild all of that, and probably gave up the name and everything else and started over. So goodwill is a very, very intangible item. It can go away in a heartbeat, and it's never realized until really the business is sold. So it's important to understand where wealth is and what it is. Most people think of wealth as people that are clipping coupons, stocks and bonds, right? And those are the people that have discretionary wealth, and those are the ones that, frankly, are going to be able to avoid any kind of tax. They can move their money offshore. They can put it into trusts. They can put it into offshore trusts. They can put it into a lot of different places. And they can continue to create wealth that can't be taxed by the U.S. government or anybody else. They have the money to live or do whatever they want, wherever they want. They don't have a job that they got to go to every day. They got passive income. They can generate that passive income in Switzerland as easily as they can generate it in Stuart, Florida. And, do they have to maybe move out of the country at some point? They may have to pay a tax when they move, but in the long run, they can go wherever they want. Many of them are free to travel anyway and do travel wherever they want. One of the things I've noticed about old money, and that's generally clipping coupons is old money a lot of times, although a lot of times it's also real estate, which is very difficult to get any income from and any cash from unless you sell it. You can borrow against it, but if you don't have any income coming from it, you're just destroying your wealth. But with a lot of this money, they can move it around, and I've noticed over the years that these wealthier families travel. It's nothing for them to travel to Europe, to travel to China, to travel to wherever they're going. They can just pick up and go. The pandemic has caused an issue, but look at how many people are trapped out of the country when the pandemic hit, and look at how many people still are locked down. Some of the families that I have, they have family members that live in London. They have family members that live in the Middle East. They have family members that live, all over the place. And it's relatively easy for them to travel. So it's also relatively easy for them to move some of their wealth from one place to another. They can change where their business is located because their business is investment. The family business is investing money. That can be done pretty much anywhere. So wealth that is tangible wealth and and that you have the ability to tax because they can pay it are the ones who can avoid it. The ones that can't pay the tax are the intangible wealth, because that's not real money. That's not cash. It's not tangible wealth until they convert it from goodwill, intangible, to tangible. So that's one thing to understand. Who can really be taxed? Because in this shell game, you have to end up in a situation where when you lift the shell and the P is there, that you can actually take it. Because if the goal is to get the P that's under the shell and you actually find it, but you can't get it, then what good does it do to find it? And that's the idea behind the shell game of taxes, is we change the name, we move it around, and we set it up so that the people who can afford to pay the taxes don't. And you can't tax them. The burden of tax is always going to fall on the person who can least afford it, even among the wealthy. The wealthy whose value is in their business, in goodwill, can least afford to pay taxes because they do not have the cash. They may have wealth. They may have a successful business. It may generate income, but not all that income is cash. That's the cruel secret of this whole process, is that there is a difference between income and cash. So when we talk about taxing income, we're not necessarily guaranteeing that the person that we're taxing will have enough cash to pay the tax. And by the way, the government doesn't accept IOUs. So they don't let you say, okay, I'll pay later. They have installment agreements. They extract a lot on installment agreements. That's debt, and they're going to take all your assets away if you don't pay. So that's not really letting you pay later. That's letting you pay later with a substantial amount of interest. So you're borrowing money, and it's the same thing. So who's going to pay? The people that are going to pay are the people that least can afford it. It's inflation hits the working poor more than anyone else because it affects the goods and services that they have to survive. It doesn't affect the wealthy person that I'm talking about that can buy the yacht. They're going to buy the yacht anyway. They don't care. It doesn't affect them. They can postpone. They, as a percentage of their income, any of these taxes are very small. So they're not going to pay. Inflation doesn't affect them as much. They have other alternatives. So inflation affects the people who can least afford it. They're the people that have to buy the food. They have to buy the drugs. They have to buy the diapers. They have to buy the clothes. They have to buy the gas to go to work to make an income. They have to make their car payment. They have to do all that. As all of those costs go up as a result of inflation, they're paying more and they can't afford it. And as a percentage of their income, it is significant, because the fact of the matter is there's a large group of people that spend exactly what they make. They're not putting a bunch of money into savings. They don't have discretionary income. They're spending everything they make to take care of their families right now. So if the government is going to increase their costs by 8 to 10% with inflation, they have taken an 8 to 10% cut in pay, right? Because if their costs go up by 8 to 10% and they were barely covering those costs before, what's happened? That means more of their income is going to go to those costs. They don't have the income. What happens at that point? Well, they get further and further in debt. They become poorer and poorer, and they move from working poor to non-working poor, and the government has to support them, is what it amounts to. So the government got what they want. They inflated it, and they taxed them through inflation to the point that they couldn't afford it anymore. Now they're dependent upon the government for survival, which is generally what the government's looking for when they're trying to hide taxes in inflation. Unless you're going to assume they're stupid, politicians are stupid, then they know that this is what they're doing to somebody. That is cruel. I mean, when you think about it, how cruel is that? To know that you're taking some person who is barely surviving. They got 3 kids. They're barely making their payments. They're barely making their house payment, their rent payment. They don't have enough food, no discretionary food. They're buying diapers, all of that kind of stuff. And you're going to make them suffer because you're going to allow those prices to increase. Well, how does government do inflation? Well, the biggest way government does inflation is they tax corporations. They tax those entities that don't have individual shareholders or individual entities, where it's not a small business that's owned by one individual or a family, even though those are people also that inflation affects. But those people don't pass the cost on as inflation. They actually are the people that end up having to fire people. The small business that can't pay it because all of their values and goodwill, they're the ones that end up having to lay you off because they have to make that payment to the government, and they don't have the cash if they're paying you your salary. They've already cut their material costs to the extent they can. They're buying from China right and left, right? Now you're telling them you can't buy from China anymore. You got to buy from the USA. Well, that increases their materials cost. So now their materials costs are going up. What are they going to reduce? Well, now their tax cost went up. What are they going to do? Well, if it's a small business owner, they're going to fire labor. That's what they're going to do. They're going to downsize. They're going to cut people. They're going to try to find technology to replace people. But the only place they've got left to go is jobs. Or they're going to lose, the small business, they're going to lose money themselves. They don't have the money. They don't have the cash. So they can't, even if they choose to pay the tax, they don't have the cash to do it unless they borrow money. If they borrow money, their profits are going to go down and they're going to have to lay people off. Now, in the big businesses that don't have the competition, the Wall Street businesses, they pass that cost along. How do they pass it along? Well, they're going to modernize, mechanize, and all that, but they've already done that because their goal is to maximize income. They've already done that. They've already maximized all that. So if they get another cost and increase taxes, so we tax the corporation because they can pay, and again in quotes, they're going to raise their price, i.e. inflation. So what happened? We hit them with inflation. So every time you hear a politician say, we're going to tax the corporations because they can pay, you will know they can't pay. And what they're really saying is, you know what, you poor person that are barely getting by, I'm going to crush you under my boot. And too bad. And I'll give you as much money as I think you deserve as long as you toe the line and agree with me. That's what they're saying. So keep that in mind when you're listening to some of this tax discussion, that there's no such thing as investment. Inflation is a tax, and it's all a shell game. Anyway, thanks for joining us here on Wednesdays. I love to rant. And thanks for joining us here on WSTU Digital 1450. We're Martin County's Heritage Station.